Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I'm doing good, Joe. Doing real good. As I let you and our special guest Adrian know today, I have to pee just a little bit, so I might be talking fast today, guys. So I'm sure you'll give me a break on that, or if I disappear for 5 minutes and Joe takes over, you will know why. But this is real life, right? So there you go. Here you go. So I'm excited. We have Adrian Chu on with us today, but first, Joe and we got to catch up. So what's going on, brother? Where are you at? What you doing?
I'm in Destin, Florida, which is pretty awesome. I've got to admit, some of the craziest sand on the beaches I've ever seen. It's like snow. It's amazing.
Wow.
Yeah.
Do you actually camp on the beach or do you guys camp or do you tent it when you can?
We are always in the Sprinter van for the most part.
Getting a little lazy, huh? Taking the easy way out, Joe. He's living in a van, taking the easy season, right?
It's money for this thing.
Clark, I hear ya. We are, us Clarkies are thinking about doing like a 10-day RV road trip this summer.
Where?
Like Highway 101 or somewhere California, maybe head that way, or maybe Tahoe-ish out that direction. We'll see.
Super cool. I love that Highway 101. Whew, so cool.
Yeah, good stuff right there. So you're still in Florida. Are you ever going to leave Florida, or are you just in love with Florida at this point?
Florida's great. We're actually headed towards New Orleans, though, this evening.
Ooh, I've never been. Can't wait. There'll be lots of eats there for you, I'm sure. Good stuff.
Yeah, absolutely. Absolutely.
Well, as I said, what? Go ahead.
How's that snow been up in the Pacific Northwest? Crazy snowboarder.
Yeah. So it's been, it has been pretty good. We haven't had that super dump, at least not at Stevens. It's been good enough to keep us going. But yeah, I've turned into a board sports freak. I spend all my free time either at a skateboard park or snowboarding these days. So I know you're proud of me.
Oh, right? Yeah.
Yes. Just got Katie all set up yesterday. We start 5 weeks of snowboard school this weekend. So anybody that wants to join us, we're up at Stevens Pass every Saturday from about 8 a.m. till about 2:30 p.m. So come join us. And that'd be super fun. That'd be a cool SIC event. But
heck yeah.
Man, since you're not participating this year, Joe, right?
I wish. I miss it. Sun's great, but powder days are the best.
Word. Well, let's jump into this so we can get rolling here, because we do have our roundtable mastermind today coming up in the next hour or so. I'm going to have to jump over to that, but we want to spend as much time as we can with our ninja guest today. He's kind of on those quiet but deadly type of investors. Multifaceted, multi-talented, super brainiac. Someone I definitely listen to when he's talking, I'm listening, that's for sure. And that is our buddy Adrian Chu. So what's up, Adrian?
Hi, Julie.
Hi.
Hi.
How you doing?
Good.
Good.
Excited to be
here.
Hey
everybody. Yeah, thanks for it's been too long. We should have had you on a long time ago. But I wanted to go on a private date with you first. Bongos, right? That's right.
That's where it's at, yeah.
That is where it's at. My favorite. So guys, Adrian, I think a lot of you guys know who Adrian Chu is. He's a local investor. He's the managing broker over at Horizon Real Estate. He is a mortgage loan originator, which is a special twist I can't wait to hear about today that I don't think I know many other investors or brokers that, do that as well. Maybe we should be. He is, I guess we'll say, the founder, correct me if I'm wrong, Adrian, of Chu Design Build. He's multifaceted investor, broker, all those things. And those are all my favorite things about Adrian, but I guess I'll say the one issue, sorry, Adrian, that I have with you is that you're a husky. And I'm a coug.
Oh.
Yep. So I like to beat up on the Huskies. This podcast, since I'm sort of in charge here with Joe, is my only opportunity to give shit to my Husky friends because pretty much you guys beat us up, as everybody knows, most of the other time. So I take it when I can. I dish it out as I can. So,
Fair enough.
there's a little poke, right? So, other than that, Joe's going to kick us off. So, Joe, kick us off.
Heck yeah.
Today.
Heck yeah. Adrian, first question of the day. We like to hear about how people have come up in the world. And what that means is we'd love to know like where you grew up, what you've done to get to the point where you are today, and if you've had any kind of influencers that have brought you along your way. So lay it on us.
All right, definitely. A little bit about myself. I was born and raised in Seattle. As a kid, kind of always was interested in different type of investments. In elementary school, that was when the tech bubble took place. I was interested in stocks. I remember I'd wake up at like 7 a.m. in the morning just to turn on CNBC and watch the stock market. I even there were some opportunities where you could call them up and there'd be an analyst who would cover a particular stock that you called them up about. So I did that a few times too. And this was all
wow, what age was
third
that?
or fourth grade. This was when I was like in
Oh
third.
my god!
Yeah,
Wow.
And then after that, I saw the stock bubble. Instantly lost interest in stocks after that.
What, in fourth grade?
Yeah, like in fourth grade.
See, told you guys we got a live one today. This is the first time that we've got on this podcast.
Right, and then it started, just becoming interested in real estate, and this was I think around middle school or so. I came across a real estate fundamentals textbook. So this is like the textbook for the pre-licensing course for the real estate broker license. And this was about seventh grade or so. I read through that book very, very quickly. Knew that at some point in life, I wanted to take that exam and invest in real estate.
Wow.
Yeah, so I got started early on in kind of thinking about real estate. So that was kind of cool.
Did your parents were they like investors or what in the heck were they like? Did you skip like 4 grades?
I definitely learned a lot from my parents. When I was younger, sometimes they go look at properties and I tag along. That's kind of the extent of that. And so in high school, in Washington, there's a program called Running Start that lets you basically skip 2 years of high school and finish college 2 years earlier. So I did that because at the time, I wanted to be able to start working and qualify for a mortgage.
Oh shit!
So junior and senior year of high school, I did Running Start, and then so by the time I finished, technically finished high school, I already had like 2 years worth of college credits. that I was able to apply, towards for college. So, I applied to UW and, did electrical engineering. So I was able to finish that in 2 years. So that was in 2011.
Oh my God.
So I
What
started
age did you graduate from UW?
20. Yeah, and then
Age 20.
I got my real estate
Jesus.
license in 2010. So I was 19 when I got my real estate license. Didn't really do that much for the first couple of years. So, at that point I was, I just finished school, studied electrical engineering. The logical next move was to get a job in the tech industry. So, that's what I did. Definitely, it's a great way to start and kind of, build up, the resources to actually start investing in real estate. I know, other people have different paths to start, but, for that one, it felt, it was a good starting point for me to kind of get into investing.
Holy smokes. I don't even know what to say. I'm like totally like, what? You didn't share this with me on our date.
But I'm grateful for all the opportunities over the years to be able to do this. And I think if I were to even enter the workforce 2 years later, I think it would have changed how I invest and so forth.
So you initially jumped into it because you wanted to buy like a primary residence for yourself, or
Yeah, something, primary residence or a rental property or just anything. So it was kind of all planned out very early on. At least that was my what I had in mind. So I
so what
wanted
was
to
the first
finish
thing
school
you actually
early. That
bought?
was
What was the first thing you actually bought then?
I bought a condo in North Seattle.
And you lived in it?
Yeah, and then so that was back in 2012, and I started off buying little condos. Not sure in retrospect, that's probably not the best way to go. At that point, I thought, okay, little condo, the risk is very low. So that's kind of how I started. Multiple little condos, and then, but I didn't leverage as much as I should have.
Wow. I'm still blown away. So, well, tell us more. So you you are now a broker. When you first got started, you were planning the whole time to invest for yourself, or were you planning to just be a traditional broker as well? I mean, you're
I was planning to
multifaceted.
invest for myself, and then the broker role was just kind of an additional avenue, like you've been talking about, in the I hear you talk about it all the time.
Yeah.
Kind of supplement the investor path, basically. Whether that be using that to help clients achieve their real estate goals, or using that as a tool for real estate investment. But when I first started, it was just me buying stuff by myself at that point in the market, 2011, 2012. The market wasn't so great. People weren't buying houses, people were skeptical. But I decided to take the plunge and do it myself, and then eventually it took a couple of years, but some of my friends started catching on, what I was doing at that time, and they wanted in, and they wanted to do something similar. So that's when I actually got started in the doing more brokerage stuff, mainly through friends. And so basically for me, it took a few years to actually ramp up to a point where I start actively doing brokerage work as well. And I think part of that was the market. And I see recently in the past 3 or 4 years, I have friends that get their license and they start selling stuff like right away, whether or not they do it part-time or full-time. So part of that is the market. But yeah, so it took me a few years to ramp up, and from the brokerage side of things, and I just started out helping friends, and They wanted to buy a home, and then friends referred me to other friends, and that's just kind of how it got started.
How'd you layer on top the mortgage loan originator stuff? How long you been doing that?
Yeah, I got my
And why?
mortgage license in 2012. I thought it would be a good synergy between the two. And, at the same, not just was it a synergy, but also, being able to understand the mortgage side of things was helpful. I wish I started understanding it earlier, and, leverage and all of that, and, how to make yourself conform to kind of conventional underwriting guidelines. If you're able to conform to that, then you can always kind of maximize your leverage in a very cost-effective way.
And so, what are some tips that you can share with us on how to do that? How to conform yourself?
Well, I think the biggest one is, if you're working a W-2 job and you want to invest in real estate, don't quit your job. Part of that is for mortgage reasons, but part of that is also, just for kind of in case things go wrong. You always want to have a backup plan. Just like when you're buying properties, you want to have multiple exit strategies when you're, trying to go into a new venture, whether that be real estate or investing or something else. I think it's always good to have multiple backup plans in place, especially now in this market. Like a few years ago, you could jump in blindly, buy anything, and still end up doing well. So I think definitely, keeping your job. Don't quit your job to become a full-time investor right away.
Right, and even once you get cruising, and you've got your time in, and you're doing well, you still might want to, try and keep your job, just for the simple fact of your borrowing capacity, right? Until you become, I think, an expert at understanding leverage and how everything works on that side of things, because you never know when you're going to need to, like you said, get out of a deal. That's a big topic these days. So let me ask you then, you've been an investor, obviously, in the game for a long time, longer than all of us probably even realized. What mistakes did you make along the way?
Selling properties too early. But hindsight's always 20/20. I think when I first started, I did a lot of flips, starting with condos and then moved on to single family homes. And, in retrospect, I definitely sold all of them too early, and I wasn't doing enough volume to make sense to flip. I feel like if you're going to do, like, let's say 1 or 2 a year, and if you're able to just hold on to the properties, that's probably a better strategy, because you put a lot of work into it, you put a lot of time into it, and you sell it, okay, you make some money, but then you get taxed a lot as well. And then, the opportunity cost of doing a flip, if you're getting loans and stuff, that kind of sets you back in terms of building a portfolio if you're trying to pursue that track as well. And at the time, I didn't really think about that. I thought, okay, flip a house, we can make $50,000 or $70,000 or whatever. That was pretty good. But, I think in the grand scheme of things, I think, I should have made it a priority earlier to consider, building a portfolio and all the good, benefits of rentals.
Yes, sir. So are you doing this pretty much all on your own, or do you have a partner, or what's up with that?
Yeah, but basically on my own. Yeah.
Nice. So what part do you like best out of what you're doing? Not necessarily what you make the most money at, but what do you like doing best? Do you like brokering or loan originations? Kind of go hand in hand, or working on your own flips?
I think everything. It's all fun. That's why I definitely have a lot more fun, in real estate than in my previous career. So everything about real estate, every day I'm very excited about it. whether that be going to look at potential properties or getting a home listed or analyzing different kind of project opportunities or going to Seattle Investor Club events or participating in podcasts. Love it all.
Awesome stuff. So, how about now that the with the shift in the market, have you refined your investing and brokering strategies to pivot, stay focused on success here with this changes going on?
Well, I think part of that is really all about adapting to the market, and there are a few ways to do that. I think one is to kind of shift the strategy over to doing more buy and holds. I think now is a better time because over the past few years, like let's say 2017, 2018, when you were doing a flip, rehab, you list it on the market at your ARV and someone bids it up 100,000 more. And I'm sure, a lot of us have seen that happen, and a lot of us are spoiled because of that. And now, you put the same amount of effort or more in doing a flip, and, if buyers aren't, so excited about it, then it just, it cuts down the return and makes it not as, cuts down on the incentive of doing a flip. So maybe better off just doing a buy and hold or a burst strategy.
Are you finding that those deals are harder to find though here in our state, the buy and hold and the burrs, or because you're a ninja broker?
A little bit. So I think so with the market shift, I notice like core Seattle areas getting hit pretty hard, but not kind of the further places further out. So like South King County or Snohomish County, those areas, they've been very resilient, I think, in terms of the shift. Not sure if you noticed the same thing, but for buy and hold properties, I tend to go for kind of the lower price point areas, because at some point the rent you can collect plateaus, and there's no point just buying a more expensive house for less cash flow. So I tend to look for areas that have a good balance between cash flow and appreciation, and that tends to be kind of the lower price point areas. So I'd say sub 400,000, and those price points they've been pretty resilient with the shift. I think they've even gone up compared to say fall 2017 or even early 2018.
Yeah.
So in that
I'm
sense,
actually
it's harder to find a good deal in that price point.
Right.
But that goes back to what you asked earlier. How does one adapt to this changing market? You shift your focus to segments of the market that are more resilient to market shifts.
Right.
Yeah.
I see that you also list a fair amount of rentals. I didn't know if that was kind of a part of your MO or opportunity to get deals that way by, offering to do, instead of brokering properties, essentially brokering leases, right, on residential properties. What's going on there with all your rental property listings? How do you pursue that business, or do you pursue that business, or does that just happen to be because you've been in the game and you have friends and family that
mostly friends and family. The primary objective there is to just kind of maintain that relationship. We all know that of course it's better to list a for sale property than the for rent property, but I do it to help out friends and family, and also maintain that relationship, so that perhaps when they do decide to sell later, they'll have someone in mind.
Exactly. Good plan. So also you do, I see broker. I don't know what your role is. Tell us what your role is. You seem to do a fair amount of brokering, at least, and you can tell me if it's more than that, to builders looking for development deals. Looks like you've had quite a bit of success getting some of those deals done. Fill us in what you're up to there, and are you brokering those deals, or are you, a lot of brokers who do land deals like that and sell to builders and so forth. I think off market, a lot of times they don't take anything up front, on an off market transaction, obviously, because they're angling for, however many listings they can get on the back end of nice high end new construction projects. What's your MO there? What are you up to?
Yeah, so I've been doing that for a few years now. It worked out kind of hand in hand with the off-market marketing that we do. So I target potential development sites. Sometimes I just send direct mail to entire zip codes with a kind of more open-ended message to see how we can offer solutions to a seller. Some sellers want a quick all cash transaction. Some sellers want to list their property, and it goes hand in hand with what I know you've been talking about this a lot, Julie. Having that real estate license and also be an investor, because most agents, when they do direct mail, there's only one message, and that message is, I want to list your home. But when I do it, I can offer multiple solutions to the seller. And so there are multiple ways to essentially monetize the same mailing piece.
Exactly.
So I definitely agree.
Mind why people are not going after that hardcore and clued in 100%. I don't know how many times we have to say it, but it's the golden key to, it's such a great thing to be able to do that, to provide those options. I just think it, especially if you're spending money on marketing. We've said that about 1 million times. So one day you guys will all figure it out. But let me ask you, so you're managing broker, right, over at Horizon Real Estate? Is that correct?
Yeah.
And do you do any wholesaling, or are you pretty much brokering your off-market deals? So
I broker them. Yeah. So I would just write the contract, on behalf of, let's say a builder deal, I'd write it on behalf of a builder, just as they're selling, as a selling broker transaction. Then, every deal is different. Yeah. Every deal works differently, but that's pretty much how I do it. I think it's just easier than, I don't want to say this, but I feel like a lot of times it's like you blindly get a deal under contract without any certainty whether it will close. And I don't feel like doing that. I'd rather just, be the broker and represent the buyer in doing it, or I buy it myself and, I tell them, I'm a broker, I'm buying this myself, and keep it at that. Instead of, I know in wholesaling, the common practice for a lot of people is if they can't find an end buyer, they just back out on inspection. And I've seen a lot of sellers just get under contract with the wholesaler and they don't end up closing. So that's the unfortunate piece, and I feel like that kind of gives a bad vibe for real estate investors, because a lot of wholesalers say, oh, I'm a real estate investor, I'm a cash buyer. It makes people feel skeptical when a lot of things like that happen. So I try to I identify the buyer first before I enter into a contract.
I love it. I tend to agree with you as well. I mean, not only that, is then you also can build a track record, right, for yourself that's good for branding and all this other stuff, and marketing yourself, right, as you're good at doing. I've noticed that you've clicked that up a notch this year, which I applaud you for. That's probably why you're getting on all these panels and asked to be guests on things like that, because it sounds like you've stepped it up in the last, I don't know, however long. I think everybody's, like Adrian Chu, what's he up to, right? Definitely. And the awesome thing, I agree, I've actually started doing that too. If we're not taking it down, how I roll is I'll just broker it as well. I mean, wholesaling, brokering, to me, it's, it's just fees, right? One way or another. And, it's cleaner and, provides a track record now that the MLS here in Washington has provided us a path to, everybody, I think a lot more off-market transactions were happening on the slide because nobody wanted to get in trouble with the MLS as an agent. But now that the MLS has made a path for agents to do off-market deals, as long as you do, a little one-page, extra piece of paperwork and report it to them, there's no trouble there, right? Where maybe people used to be intimidated by the gray area of that. It's no longer gray. So, there's all kinds of ways to skin the cat. My number one goal is to do that legally, ethically, by the book, by the rules. So whoever's listening, if that is important to you, you are hanging out with the right crowd, because there are no cowboys. We don't or cowgirls. We want to teach you guys the rules. And as long as everybody knows the rules, there's totally ways to operate by and within those rules. So why make your life complicated by, wanting to operate outside of those rules is what I think.
Hey guys, Joe here. I just want to take this super quick break from the action to let you know something that we have really cool to offer you guys. As you know, marketing is the lifeblood of our real estate business, and Julie and I spend a ton of money sending out postcards and letters to people all around the Seattle area. We've partnered up with YellowLetters.com to get you guys 10% off all of your marketing needs at Yellow Letters. All you have to do is go to YellowLetters.com, and when you check out, use the code Seattle Investors Club, and you'll get 10% off any of your marketing needs at YellowLetters.com. You can send postcards, letters, whatever it may be that YellowLetters.com has, so that you can keep your marketing engine running for a little less money. So go to YellowLetters.com, use the code Seattle Investors Club with no spaces, and get your marketing going today. All right, let's get back to the action.
So what are you focusing on these days? Are you going after, let's talk some buzzwords that I know that we got 3 kind of buzzword topics that I'll mention. One of those would be, maybe, let me pick one here. ADUs or DADUs are a hot topic these days. What's your take on those? Are they even really feasible to build here in the Seattle area? I know it's super expensive to build those. What are the rules? What can you share with us that you know?
Yeah, so ADUs are it's an interesting topic, especially in Seattle. The city's trying to kind of revamp the legislation for ADUs. And I think, ADUs is conceptually, I think it's a way for the city to create more housing supply. Basically, it allows one to take a single family zone lot that could only fit one house in the past. They could build a second home, on that lot, provided that it meets the ADU guidelines. So, for example, it has to right now. If you want to,
let's tell them what ADU and DADU means. So ADU stands for what?
So ADU is an accessory dwelling unit, and there are 2 variants of accessory dwelling units. One is a AADU, which is an attached ADU, and then there's a DADU, which is a detached ADU.
Yep.
Yeah, so attached ADU is basically like a mother-in-law unit that's permanent, that conforms with the city kind of rules and regulations. Basically, it's attached to the main home. So imagine like the most common scenario would be like a basement that's converted into a separate unit with a separate entrance, and basically functions like a duplex, except that the rules say that one of the units have to be owner occupied, either the main part of the house or the the ADU. Likewise with the detached
ADU. Do you think it's going to change?
There's a lot of talk about revamping the plans, but it really it takes a while for things to change in the city, so we'll see. I don't know.
Right, and then the detached ADU.
Yeah, so detached ADU is like a backyard cottage, basically. It's a separate structure. Based on current code, it almost always has to be behind the main house, so it always ends up being like a backyard cottage.
And again, those have to be owner-occupied properties, main properties, to be able to build that or get a permit for
so
that?
one of the two homes have to be owner occupied.
So how does an investor even partake, or is this more of an idea for people to use their own properties that they already own for those purposes? Or it's great, obviously people are going to be interested in buying those from a brokerage perspective, but what about from an investor? Is there really a play there right now since it's not owner occupied?
Well, you can build it, essentially sell it to owner-occupied buyer, or if you're living in the main house or you want to build a second home on your own lot and rent out one of them, I think that's an interesting play.
Do
The
what?
other,
Say that again?
basically, if you live in one of the two houses, right, you can either you build a backyard cottage, you live in there yourself, and then you rent out the main house, or vice versa. So that could be an interesting play, especially if your lot has a big enough backyard. The biggest
And
surprise.
definitely when you're looking for the bidders, I mean, maybe, focusing on properties that, once legislation moves forward and changes, I imagine something's going to work in our favor because they have no choice. They're going to have to, we have a housing supply issue, right? It feels like something's going to have to happen on a give in regards to that. So maybe when you guys are all out there looking for your burrs and stuff like that, buying properties where that is something that can be done either now or later would be a good focus. But are there how many people, you think there's a ton of people out there just putting mother-in-laws that are without a permit in there? And why is that a negative? Is that is it for financing purposes? Did it affect anything whether you have a permit or not if you have a attached mother-in-law in the basement or something?
Generally, no. For appraisers, they look at the house, and if it looks relatively normal to them, they see similar homes in the neighborhood that have a setup like that. Generally, it doesn't become an issue. I think it's more relevant for I would say the backyard cottage, right? You're building a new structure, essentially.
Well, let me go back to the mother-in-law first. What if you are so what if you've got your mother-in-law and a normal house with a single tenant rents for $2,500, but with a mother-in-law setup top and bottom, you're collecting $3,000. If you are using that as a rental property, are they going to give you the value of the $3,000, or are they going to limit it to the $2,500 for your
it would be based on what market rents are, but it most likely be the 2,500 if you're getting a mortgage on the subject property. If you're using that rental income to get a mortgage on a different property, then you'd use the full rental income. But if that's the subject property, if you're getting a loan on that property, then it's really just based on what the appraised rental value is, the lesser of either the rental value or what you're getting. So there's a little nuance.
I think that's an important point that everybody needs to remember, because I think people, inexperienced people that jump into this sometimes, they don't realize that why they might be collecting two types of rent on the property, that they might, when they go to refinance, they might not get credit for that full amount,
depending on the scenario.
Right, exactly. So let's go back to the DADUs for a minute. To me, that is super interesting, but they're super expensive to build, right? I think that's what
they are. I think part of the reason is that it's such a small footprint, and also you still have to do all the work to pull the utilities and all that, because the utilities would most likely be with the front house, so you have to pull the utilities to the backyard. Whereas you have some other new build scenarios where the utilities are already in the lot and you just kind of build on top of it. With this one, you got to
Right.
pull the utilities to the back, and given the fact that it's such a small footprint, the unit cost of everything goes up. You still have one kitchen and at least one bathroom, so you don't really, the expensive stuff, you're still stuck with it. So the unit costs, ends up going up.
Right.
And
So,
I
yep.
think the more complicated piece here is, if you try to build something yourself, you really miss out on the ability to leverage, because it's very limited the kind of loans you can get to finance building an ADU. So if you think about it,
And
you either have to get a special construction loan, or use your HELOC, or use your savings, and basic that could
and then
set you back.
in my opinion, you better stay there, because I don't think there's been enough. I mean, if somebody's trying to sell a property that has a, detached dwelling unit on it for appraisal purposes, those people they want a major premium for that, right?
Mm-hmm.
But what's your take on that in regards to appraisers? I mean, I don't think that there's enough of them yet that people are getting the full credit for those
Right,
units.
yeah, that too, yeah.
So it's something to keep our eyes on for sure. Definitely, if you own a property where you qualify for that sort of thing, go for it. Or at least on the attached dwelling unit is such a great idea. But yep, that's an interesting topic. I don't know if in other, if it's cheaper elsewhere, but it is right now. It is something to keep your eyes on. Well, let's shift then. Let's talk about opportunity zones. What can you tell us about opportunity zones? I know that you're one of those guys that's a smarty pants that's keeping on top of all that stuff. And people are listening when you're talking. So tell us what opportunity zones are, and, what you're doing for your own business to keep your eyes and ears open for opportunities there.
Right. So yeah, that's kind of the stage I'm at right now, just keeping my eyes and ears open. It's a new tax kind of law that got passed at the end of 2017, but a lot of the details are still being refined as we speak. So just a disclaimer, I'm not a CPA or a tax attorney. Encourage you guys to do your own research. Not yet. But anyway, I think it's the essence is that you can use your capital gains from other sources, whether that be selling a rental property or flip or stocks or cryptocurrency or whatever. So it counts both short-term and long-term capital gains, and you can defer those gains. Defer the taxes for those gains until I think 2026. If you reinvest those proceeds to what they call a qualified opportunity fund, which is an entity that you could set up. And the idea is that you have to use the money inside that opportunity fund to invest in stuff that's inside a designated opportunity zone. And to find out what a designated opportunity zone is, you can go to look at the maps online. Every state government, they publish a map showing, what the opportunity zones are, and they're based on census tracts where somebody felt that, need kind of, I should say, basically they want to transform the area, kind of change the area and improve the area. So in Seattle, there's some actually core Seattle areas that are designated on the map. So including Central District, First Hill, North Beacon Hill, Othello Station, White Center, so forth. And, other cities have different areas. For example, like Portland, the whole downtown is an opportunity zone. So that's kind of interesting if you want to do the big projects. But anyway, so that's kind of, in short, that's what the opportunity zone is. And so you have to invest the money into an opportunity zone project. You can defer your capital gains. And the catch is you have to improve that opportunity zone property. And their definition of that is you have to double the improvement basis, the value of that within, I think, the first 3 years. So when you buy a property, you try to calculate tax basis. There's a land component, there's the improvement component. So you got to double the value of the improvement component.
What would be an example of where that might work?
Well,
I
in
mean,
Seattle, I think the only way to do it is to
piece of
do a
dirt.
new build or like a really substantial remodel, given the cost of things. Right. If you
Right.
let's say you buy a property that's say 500,000, where 200,000 is the land and 300,000 is the improvement. Basically, you have to put in another 300,000 into improving the property in order for it to count, to qualify as a opportunity zone investment. So it's pretty hard. I think it's pretty hard to do a $300,000 rehab unless it's a pretty substantial one. And so it might make more sense for new construction. So you build new construction, and then what you have to do after that is, if you keep it as a rental for 10 years, the gains you make from the opportunity zone investment are completely tax-free.
Bling, 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 bling.
So that's a big one. But, basically, though, you basically have to do something that fits in with a buy and hold strategy. And I think just, based on my surface level analysis of it, it doesn't make sense to do something just because it's in the opportunity zone. It should be something that you're otherwise going to do anyway.
Right.
Because I think just for the tax benefit itself, it might not make sense. And okay, let's say you want to do something in Seattle with construction costs so high and land costs so high. If you just count the kind of at cost what you're paying out and whether that makes sense to hold as a rental, I think it's a little bit tight.
Right.
Yeah.
You think there's going to be, how long though do you have to find that, let's say it goes into a fund. Let's say you sell something and it goes into one of these opportunity zone funds, right? Same as, doing a 1031, let's just say, and you put your money with the exchange facilitator, you have X number of days to find your replacement property. I don't know why. I thought I read that, the time frames are longer. Does that make any sense on how long you have?
Yeah, I don't remember the exact number, but it's definitely something we can Google and find out. But there is a grace period, and it's longer than for 1031 exchange. And then the other benefit is that you don't have to invest your whole sale amount into the opportunity zone, only the gains portion of it. So
Right.
that part makes it a lot better than a 1031. So I think this works out great for if you have a lot of like flips or speculative new builds that you end up having a lot of capital gains for. This could be a way to kind of minimize that, or for people that that have a lot of stocks. I know the stock market isn't so great now, but if you have a lot of company stock or whatnot, then that could be another avenue to kind of reinvest the proceeds.
Well, do us a favor. If you end up either doing those or finding out or knowing somebody that does one of those, we want to have you back on or at SIC or maybe some sort of webinar on like a case study.
Sure, yeah, totally.
So hit me up when you witness that, because I know you're on top of that kind of stuff. Well, let's shift and our third kind of thing that's kind of a ninja and higher level stuff that I know understand is tell everybody about what HALA MHA proposed rezone is, what's going on with that, and why investors should be paying attention.
Yeah, so in Seattle, there's been a lot of discussion over rezoning certain single family neighborhoods and upzoning kind of existing multifamily and commercial areas as well. It's been a very long kind of multi-year effort so far, and things are getting closer to the finish line. But part of the idea of that is that Seattle has a housing shortage, and the city wants to come up with a way to solve that. So part of that is to upzone certain areas and expand the size of what they call urban villages. So urban villages are kind of more commercial, multifamily type of areas that have a lot of walkable activity and whatnot going on. And so that's the idea, where the city has a map where they say, okay, these parcels will be rezoned. The cost of actually as a property owner or a investor, if you want to benefit from the rezone, then there's a fee you have to pay when you try to develop the property there once the rezone passes, and it's based on the square footage of what you're trying to build. So I think it's anywhere around like $8 or $9 a foot to I think like 25 or $30 a foot, depending on the neighborhood. So that's a fee that you pay to the city. I understand, when you get permits, or you have to offer a certain number of units, as affordable housing. That's the other.
Do you think that builders right now are putting the brakes on a little bit to before, so they understand exactly what those rules are? Since I don't think they're nothing's set in stone quite yet. Do you sense, because you work with builders, is there any pause going on in the market?
Well,
or
there
waiting?
are two groups of people. One, we have the professional builders, where they just build and build. That's their job. And we have investors that are kind of mostly speculating on the MHA rezones. Most builders, they don't even look at the rezone properties, just because there's that speculation risk. They're in the business to build and sell, essentially, a lot of what builders do, and
Right.
they're not in the business to speculate on zoning changes, right? They have their crews, they have their subs, they want to keep them busy, so their business is to just build, and they only can build when the zoning allows them to. So most, if not all, builders, they only focus on the existing multifamily zone properties, for townhomes.
And they know they're going to get those calls once that passes from all the people sitting there watching that stuff. They're going to be calling those builders to pick them up off them and stuff like that.
Right, exactly. But then right now, interesting timing, there's this, market shift. So that's been kind of changing things quite a bit. Builders are not wanting.
Yeah, how has that affected your projects?
Well,
are any projects being affected by the shift?
I think everybody's affected, right? In terms of whether you have a spec build or a rehab, or even as a broker. But builders are not willing to pay as much for land. Sellers, on the other hand, haven't adjusted to the change. As you think about it, sellers of these, let's say, LR multifamily zone properties, they get letters and postcards every week, probably like 3 or 5 a week.
Right.
And if they haven't sold in the past 6 or 7 years, that generally means that the prices, the offers they've gotten didn't meet their expectations, even at the peak of the market. And now, builders they're paying, let's say, 20% less than what they would have paid a year ago. So,
right,
from when you talk to a seller, the seller didn't like the price that was 20% higher. Let's say they got an offer for $1 million a year and a half ago, and now the builder wants to come in at, say, 750, 800. And unless the seller has to sell, they're not going to want to take that offer. So it's pretty hard, to find a seller these days for multifamily zone property.
Yeah, it's an interesting time.
Yeah, and then at the same time, subcontractors, they haven't really adjusted that much either. So land prices are all-time high, construction costs all-time high, but exit values are like 15-20% less than what they were, and who knows what they would be 2 years from now.
That's the thing. Who knows?
So that's
what
a big
they'll be 2
uncertainty.
years from now.
So yeah, that's definitely affected the way builders have perceived value in terms of potential projects.
Right. So
Yeah.
one thing we do know though is we do know about light rail, right?
We
We know
do.
more
We
about
do.
light rail days, and that is something that as far as if you are focusing where you're doing your marketing, are you choosing areas based on? It sounds like are you focused on anything? Are you focused on light rail, close to light rail? Are you focused on any of these things, or how do you decide where you're going to do your direct mail?
Mostly it kind of starts off where, where I've been doing my projects and where I've been doing the listings and kind of, work around those areas. I know I should be more systematic with direct mail, and which I haven't been. Um, I just kind of send them out when I have time, but I think it should be definitely more of a systemized process. Um, in terms of light rail, yeah, I got a little pamphlet in the mail the other day from Sound Transit where they um, share kind of their grand plan, and it's cool that there's a very elaborate system map that's being worked on. But I see some of those timelines are like 2035 or even like I think 2040 or something. So it's going to take some time for some areas to actually get the light rail. Um, so
What do you think are the hottest areas in King County right now? Pockets in King County, like White Center, Tukwila.
it's
I don't know. What are
Yeah,
you
it's hard to
thinking?
say. I think in the past, after the shift, I think Tequila, White Center, Burien, like all those, South King areas or Des Moines even, those areas have been resilient. And because they've been resilient, prices have gone up higher, despite the shift.
Yeah,
Whereas, in Seattle, kind of core Seattle areas or inside anywhere kind of inside city limits, prices have dropped, in a lot of cases. I've had listings from a year
right.
ago that got bid up, multiple offers. Had this one listing that got 9 offers. Like 7 of them were cash. We got bid up substantially above asking price, and then a few months ago, I saw a similar listing, maybe even better, a better property than the one I had listed. It was listed at a price that was way lower than what we had sold for, and it was sitting on the market for like 2-3 months. So
Yep.
it's kind of interesting that right now we're at a point where the South King County areas have they're still kind of flat or gone up, but core Seattle areas have dropped a lot. So it kind of depends on what the price was. I think if we're sub 400 areas, those have been still going pretty strong. But I think the more of the median price point stuff, I think median price points like 700 or something, 7 something here. Those have been hit pretty hard in the past year with the shift. So maybe it's time to venture back into the city. I don't know. Still kind of taking a look at things. But in terms of back to what you're saying about light rail, so the next plan for light rail is north, so Northgate and Shoreline and Linwood and all that stuff. I know a lot of builders trying to look at stuff in Shoreline, and one interesting nuance in Shoreline is kind of funny, but kind of makes things difficult, is that the city decided to upzone a lot of areas near the proposed light rail stations, but knowing what Shoreline looks like, when a lot of those neighborhoods were initially platted back in like the 1950s, 1960s, or 70s, it was meant to be kind of a suburban residential neighborhood. And because of that, those neighborhoods, some of them have CCNRs that
Yep.
that says things like the lot cannot be subdivided. The lot can, you
Right.
cannot build more than a 2-story home on that lot, but the city says you can build, 55 feet high. So we get these conflicts.
I have totally had the deal like that, right? And
Yeah.
it's you got to watch that, everybody. That is exactly right. I experienced that myself on a deal in Shoreline. I thought, heck yeah. But it had the CCNRs and these deed restrictions and stuff. And, the city was like, oh, no, you can do it. And I was like, I don't know. I mean, and I think we were talking about that time, if you had X amount of the homeowners within that, that subdivision agree, then maybe you're going to be able to get that changed. But,
I understand
that adds
you
on a
need
whole nother
100% of the owners, which is kind of
Right.
difficult, I think. Yeah. Because those are big
Difficult,
neighborhoods
right?
too. They
Yeah.
can be like, a few blocks, 40 homes, 50 homes, 60 homes, and you got to get everyone on board. I think that could be challenging. So yeah, conflicts
So
like
if you
that.
guys are listening,
Yeah, so that's definitely
make sure
something
you
to pay attention to.
the CCNRs, right? You guys got to
Yeah.
look at that stuff. If you run across deals that you think are, within these rezones or up zones, that's one layer of due diligence and review, but you need to actually make sure there aren't any CCRs or deed restrictions on these properties as well.
Yeah,
Great.
so the title report's your friend, have a good title rep, get those title reports, read
Exactly.
them. Yeah.
Well, hey guys, remember in the beginning I said I have to pee? I still have to pee, so I'm going to book it here down. Adrian,
Okay.
tell us, you've got a Facebook group or two that you are either part of or started. Tell us which ones that you would like people to check out and maybe join. I think you've got one called House Hacks, Financial Independence Through Real Estate.
Yeah.
I don't
So
know if
I put that together. Actually, I put that together a few years ago, but didn't really end up using it. It was more, I had some friends that got their real estate license. At first, I was like, oh, this could be a good idea to kind of, brainstorm ideas, how to start out, how to, kind of grow a real estate brokerage business. And then it kind of pivoted because I had another idea that was, now the kind of vision is to focus on, like strategies and tactics to essentially go from a 9 to 5 into financial independence through real estate. It's kind of, what I've been doing, and I figured it'd be a good, kind of platform for us to, simply talk about, things, actions, strategies. I noticed a lot of Facebook groups out there, they get there's a lot of content in them, and they're not very focused, on a particular thing. So that's fun.
Right.
And I've been, helping out Jan in the Washington Real Estate Investing Group. I think it's an awesome group. Lots of members. Everyone's very engaged. Great resource. Everyone's willing to kind of offer their opinion and suggestions and share their experiences. Especially a lot of people post they need they have a scenario at a rental property or stuff like that. So I think it's a great community of people, and if you're not a member, definitely join and check it out.
Absolutely. I agree 100%. We love all our investor friends, no doubt about that. Well, you guys, Adrian, as you can tell, is a wealth of knowledge. This guy pretty much can do anything with any piece of property, knows what's up. And I know a lot of you out there may need some help, and it's always good to get help from, get the point of view and opinion of a few different people. And this guy should be one of those guys that you call, especially on development deals and anything to do with that kind of stuff. I think that he is a super resource for you guys. Mortgages, you need some help with lending and understanding all that for your deals or for your personal self. He'd be your guy as well. So Adrian, how can people reach you if they want to run something by you?
Well, my contact information, you can probably Google it. As with all, a lot of real estate people, you just Google it. But any medium is fine. Phone,
do you prefer
text,
to be
Facebook,
do you prefer to be
LinkedIn.
contacted phone or email? Do you prefer?
Either way is fine. Email tends to be better, but phone's fine too.
Right on.
All over social media: Facebook, LinkedIn, Instagram, WeChat, whatever.
That's right. It's easy to track people down these days.
Yeah.
Well, super. I'm awesome for hanging out with us today.
Yeah, likewise. Thanks for having me.
Yeah. We'll do it again. Bring us like a killer case study on some awesome deal that touches upon some of the stuff that we talked about, and we'll
okay, totally.
That'd be fun to do. So, Joe, where can everybody get the details about today's podcast?
Yeah. If you want to read this or get the show notes at all, you can go to seattleinvestorsclub.com/64. That's seattleinvestorsclub.com/64. And get this, everybody. I've recently learned that it helps us out the most if you hit the subscribe button. iTunes likes that the best if we have more subscribers. So it's totally free. And all you have to do is go to seattleinvestorsclub.com/iTunes and hit subscribe. And then you'll get the shows, in your iTunes app every single week. So we'd love it.
Well, I know I've subscribed, Joe. So I am
too.
enjoying it myself. All right, guys, over and out. Everybody have a good, productive, successful week, and we will catch you next time. Thanks again, Adrian. We'll see you soon.
Thanks, Julie. Thanks, Joe.
All right. Bye.
Over and out.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.